Most traders don't lose money because they are stupid, careless, or lazy. They lose money because they act before the market has finished speaking. Jesse Livermore learned early that being right too early was often indistinguishable from being wrong, and worse, it slowly destroyed a trader's confidence. He watched men call turns perfectly and still go broke because they entered before the market was ready to move. The market does not reward opinions, forecasts, or courage. It rewards alignment with what is, not what should be. Livermore believed the tape told the truth long before your emotions ever did, but only if you waited long enough to hear it clearly. Impatient traders mistake activity for progress and prediction for skill. They believe that foresight is the goal, when survival is the first requirement. If you're listening carefully now, understand this clearly. The market will always offer another opportunity, but it will not forgive impatience. What follows is not about genius or intuition, but about discipline, restraint, and confirmation. Livermore's greatest fortunes came not from guessing first, but from arriving prepared. If you miss this lesson, nothing else will save you. If you absorb it, everything else becomes simpler. This lesson separates professionals from gamblers. Livermore often observed that the public loves anticipation because it makes them feel clever, even when it costs them money. He wrote repeatedly that losing traders wanted to be first, while winning traders wanted to be right. In bucket shops and later on Wall Street, he saw men jump into trades because they felt something was about to happen, not because the market had confirmed it. These traders confused hope with evidence and impatience with insight. Livermore learned the hard way that the market rarely moves on your schedule. It moves when supply overwhelms demand, or demand overwhelms supply, not when a trader feels restless. Waiting for confirmation meant allowing price to show its hand by behavior, not interpretation. Confirmation was never about a single tick or candle, but about sustained action in the direction of least resistance. Livermore stressed that the tape had rhythm, pauses, and false starts that trapped those who acted too quickly. He noted that many men took small early profits only to re-enter poorly out of frustration. Those who waited entered fewer trades but larger ones. The urge to predict is emotional. The act of confirming is professional. Most traders never bridge that gap. Early in his career, Livermore was obsessed with timing, tops and bottoms, believing mastery came from precision. That belief cost him dearly. He learned that no fortune was ever made by catching the exact turning point, but many fortunes were lost trying. Livermore discovered that confirmation meant accepting you would never buy the low or sell the high. It required humility and patience, qualities few speculators genuinely possess. He wrote that the big money was made not in the anticipation, but in the sitting after. The market declared its intention. Traders who waited for confirmation did not feel smart at entry. They felt late. Yet those trades paid them. Livermore observed that a trade that feels obvious is often already too late, but a trade that feels uncomfortable because it requires waiting is frequently the right one. Confirmation meant surrendering the ego's need for recognition. It also meant avoiding the emotional exhaustion of constant decisions. In confirmation, a trader regains control by letting price lead. This principle became foundational to his later success. Livermore believed that confirmation came from strength showing strength and weakness, showing weakness, not from static price levels. He waited for breakouts that held, not those that flashed briefly. He waited for reactions that failed, not those that merely paused. Confirmation, to him, was proof that other money agreed with his thesis. He never relied on private theories when the tape contradicted him. Many traders fail because they trade logic rather than behavior. The market does not move because it should. It moves because pressure builds. Livermore waited for pressure to reveal itself. When confirmation appeared, he pressed his position decisively. Without confirmation, he stood aside regardless of how compelling the story seemed. This discipline allowed him to survive long stretches of inactivity without forcing trades. He understood boredom was safer than excitement. Confirmation was his shield against overtrading. Without it, he knew ruin was inevitable. One of Livermore's most painful lessons came from trades that were ultimately correct, but entered prematurely. He saw positions move against him far enough to trigger doubt, emotional decisions, or stop-outs, before finally moving as expected. These experiences taught him that timing mattered more than correctness. Being early tied up capital, drained confidence, and distorted judgment. Confirmation acted as insurance against these risks. It filtered out scenarios where patience was required before commitment. Livermore often remarked that the market will always test conviction before rewarding it, and entering too early intensifies that test unnecessarily. Traders who wait allow the market to absorb bad news, shake out weak hands, and clarify direction. Without confirmation, a trader becomes a hostage to noise. With confirmation, he participates in momentum. This difference is subtle but decisive. Livermore's later trades reflected fewer entries but higher conviction. He learned to let the market earn his participation. Livermore distinguished sharply between initiative and response. He warned against initiative trades that were not confirmed. Initiative without confirmation is speculation at its weakest. Response trading, however, meant acting only after the market demonstrated direction. He trained himself to identify pivotal moments when price behavior changed character. These moments were not predicted. They were observed. Traders who acted at these points felt late, but were, in truth, aligned. Livermore accepted that missing the first part of a move was the cost of safety. That cost was far smaller than the losses incurred by false starts. Confirmation allowed a trader to risk capital when probabilities improved. Without it, every trade is a guess, dressed up as a plan. Most traders never learn to wait. Those who do separate themselves quietly and permanently. Impatience, Livermore observed, was not just a personality trait, but a survival threat. The urge to act grows stronger during quiet markets, just when discipline is most needed. Traders convince themselves that confirming signals are unnecessary because opportunity feels scarce. Livermore rejected this thinking entirely. He believed opportunity was infinite, but capital was not. Confirmation preserved capital by reducing unnecessary exposure. It also preserved emotional clarity by limiting decisions. Traders who wait trade less, but they trade better. Livermore wrote that he often felt his greatest skill was knowing when not to act. Confirmation gave him permission to do nothing without guilt. Most losses, he observed, occurred when traders were bored, anxious, or seeking excitement. Waiting for confirmation removed those impulses. It restored trading to a professional craft. Livermore also understood that confirmation protected against overconfidence. After periods of success, traders tend to anticipate movement rather than wait for proof. This behavior often leads to sharp drawdowns. Livermore himself experienced this repeatedly throughout his career. Each time, he returned to confirmation as his anchor. He wrote that experience taught him to distrust enthusiasm and respect evidence. Confirmation does not excite, it reassures. It replaces emotion with structure. Traders who master this principle become less reactive. They stop chasing rumors, tips, and narratives. Instead, they respond to price behavior. This shift transforms trading from emotional turmoil into strategic engagement. Livermore's later writings emphasize this discipline repeatedly. Confirmation was not optional, it was mandatory. Another critical aspect of confirmation was scale. Livermore rarely committed full size immediately. Even with confirmation, he entered carefully. He added only after the market continued to validate his position. This pyramiding approach depended entirely on confirmation at each stage. Traders who go all in early remove flexibility. Livermore valued flexibility above bravado. He preferred to build positions only as the market proved him correct. This philosophy allowed him to ride trends without fear. Without confirmation, scaling becomes reckless. With confirmation, it becomes powerful. Livermore's success during major market moves depended on this patience-driven structure. Confirmation governed not just entry, but position management. It was woven into every decision he made. Livermore also warned that confirmation does not mean certainty. Even confirmed trades can fail. The difference is that risk is better defined. Confirmation reduces frequency, not risk entirely. This distinction is vital. Traders who wait for confirmation still accept losses calmly because those losses occur within a rational framework. Livermore took losses without hesitation even after confirmation failed. His discipline required emotional neutrality. Confirmation was not about eliminating pain. It was about ensuring pain was purposeful, limited, and survivable. Traders who skip confirmation often face chaotic losses that erode trust in themselves. Those who wait maintain consistency. This consistency compounds over time. Livermore valued long-term survival over short-term triumph. Perhaps most importantly, confirmation allowed Livermore to align with the trend rather than fight it. He believed the market's trend was the ultimate confirmation. Counter-trend anticipation was seductive but costly. Confirmation meant accepting the direction already established. Livermore resisted the temptation to fade strength or buy weakness prematurely. He waited for evidence that the dominant force remained intact. This approach made his largest fortunes possible. Traders who chase reversals often experience repeated small losses that add up. Confirmation kept Livermore aligned with power, not hope. It anchored him to reality. Without this discipline, even great insight becomes irrelevant. Confirmation ensured his insight was actionable. Livermore's insistence on confirmation was not theoretical. It was forged through ruin and recovery. After each failure, he returned to patience. He wrote openly about how ignoring confirmation led him into trouble. His greatest recoveries came after reaffirming this discipline. Confirmation restored his confidence because it grounded his decisions in observable reality. Traders often search for better strategies, indicators, or tools. Livermore focused on behavior. Confirmation was behavioral, not technical. It transcended market conditions and time frames. That is why it remains relevant today. The instruments have changed, but human behavior has not. Confirmation still separates survival from destruction. In summary, Jesse Livermore understood that survival in the markets depended not on brilliance, speed, or boldness, but on patience and proof. Waiting for confirmation was how he protected capital, filtered emotion, and aligned himself with the real forces moving price. Traders who insist on being first rarely stay solvent, while those willing to arrive late but prepared endure. If you struggle with premature entries, emotional conviction, or the constant urge to predict, this lesson matters more than any tactic you will ever learn. Learn to let the market speak before you act. Learn to accept missed opportunity as the price of discipline. Learn to trade response instead of impulse. When you do, trading becomes calmer, clearer, and far more sustainable. In the next video, we will go deeper into confirmation itself, what it truly looks like in real market behavior, how Livermore distinguished genuine confirmation from false signals, and how mastering this single skill can radically reduce mistakes and improve consistency. Until then, remember, the market does not reward those who guess early, but those who act decisively after the truth is revealed.